HRB is up around 15% in the past year, and today we'll be looking at a highly attractive company which is lacking growth but may be the perfect recovery play. This is currently a troubled growth machine, but this may change in the future. They currently only have around a 4% year-over-year revenue growth, but they have had consecutive quarters with constant net margins. So today we'll be looking at H&R Block, a tax preparation company. In their annual report, they state that they provide tax preparation services and other financial products to individual clients and small businesses. HRB basically consists of a franchisee model where they have different franchises spread across the world, which help clients everywhere through global tax preparation services, financial products, and even small business solutions. Just so you get an idea of the size of this company, during 2024, so in this year, they have prepared over 11.4 million assisted US tax returns and over 3.8 million do-it-yourself online paid tax returns. The one thing about this model is that they charge royalties depending on how much each customer is actually saving on their taxes. And one really good thing that I like about their business model is that they state that in case their software makes an error while preparing the tax returns and you have to pay more later on or something goes wrong, they do provide a reimbursement to the client of around $10,000 maximum. But this is really good because it gives new customers that peace of mind that they're so sure about their software and their services that there is a very low probability of something goes wrong. And even if it does, they will actually compensate you for around $10,000, which is not bad. Then, of course, they have the other offering segment where they include even cards such as a debit MasterCard, where, for example, all the money you actually saved with your tax filings is deposited directly into this debit card. Then they also offer microloans up to $1,300 in order to pay any taxes that haven't been paid up yet. And finally, they have the small business financial solutions where they basically act as an accountant and they do everything from taxes, bookkeeping, payroll, and just make the life of small businesses a lot simpler. But when we look at their financial analysis is where this company really shines, as they have a return on capital employed of 47%, which is insanely high. But of course, this makes sense since they're a franchise company, meaning that they're not very asset heavy and the majority of their profits actually come as royalties from their franchisees. They have an interest coverage ratio of 9 times, which is not bad. Our threshold is usually 10 times, but since they have a stable income, it's not too much to worry about. Then they have a 90% cash conversion rate, a profit margin of 45%, and an operating margin of 16%, right above our threshold. This is what I was stating previously. Their revenue has been extremely consistent for the past quarters, trailing all the way back to June 2022. And of course, since their margins have been fairly consistent, their net income and their gross profit have been in line with the past as well. And when we look at their efficiency ratios, not much has changed. They've been extremely consistent. One thing to note is that they don't have a return on equity because it seems like their equity is negative. As we can see over here, they have maintained their total assets just at about where their total liabilities are, and this actually makes for their equity to sometimes be positive, sometimes negative, which actually distorts the calculation for the return on equity. And this is my first red flag. I don't really like companies which are trailing on the negative equity side for a long time, and this company seems like it is over leveraged when taking into account that it is basically not growing at a fast pace. But now when we look at their fundamental analysis, this company gets a solid 3 out of 8 ticks. The ticks being that they can provide extremely consistent and predictable free cash flow, that they pay dividends, and they even conduct share buybacks with these free cash flows. And I believe that they do have an existing moat or competitive advantage because of the reason that I commented earlier. Once you file your taxes using HRB, if you've actually managed to save money and if you haven't had any problems with the company, which is very likely, you are extremely likely to come back the following year to file your taxes with them, because it takes a lot of time to do it by yourself, and this simplifies your life and gives you free time, especially when you know that you can trust that they will do it correctly. It's very difficult for a new competitor to come in and offer you that sense of trustworthiness that HRB already has when you've worked with them before. So to me, this is a very pure form of competitive advantage. However, there are a few things that I didn't like, such as the fact that they don't have low liability risk as their interest coverage ratio is below 10 times, the fact that they don't have a solid balance sheet because of their sometimes negative equity. I like companies which are not that leveraged when comparing to their total assets. And now they're not managing to actually grow their free cash flow, and this is mainly because they're also not able to grow at a substantial pace their revenues. And the final thing here is that I don't actually believe that they have pricing power. And this is because, and to me, pricing power is the ability of actually being able to increase your prices above the inflation rate without losing many clients. In this case, since the business model reflects on the royalties that the clients actually get from their tax filings, I don't think they have too much power on this. They maintain a very solid percentage of these royalties throughout the year, very stable, but their revenues are extremely dependent on the results that their clients are actually getting. And to me, this is not pricing power. Now, they do pay a very, very juicy dividend with a dividend yield of 2.42% at the moment, and they actually have a payout ratio of 33%, which is not bad. It basically means that they have a lot of room to run when increasing their dividend amounts. And when we look at their valuation analysis, we can see that before March 2022, they were actually having negative earnings, but now it seems like they're priced at above their historic averages, trading at around a 13 PE ratio. And when we look at their free cash flow yield of 2.31%, it seems like this is a lot lower than the long-term inflation rate of 3%, suggesting that the company may be overvalued. And now when we look at the risks and possible challenges, I do see a lot of risks. For example, the worsening competitive landscape. There are a lot of companies that are now innovating in this type of business model who are providing a lot better offers. Everything is more digitized. They're actually able to do this through AI, and the whole process is overall getting simpler. Now, there may be possible upcoming regulation changes, but I don't see this happening in the short term. And this is just something to keep in mind, that they could actually change the way that taxes are filed. They could make it a lot more intuitive, which would eliminate a lot of revenues from these type of companies. But the biggest risk that I see is actually market risk, especially considering that in economic downturns or cyclicality risks, people are less likely to actually hire these services and just stay home and actually file the tax returns themselves, because these services are not cheap and you can save a lot more money just by doing the tax filings yourself and saving that commission that HRB would take. So now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage. They provide consistent cash flows, which at least are predictable, and they have a higher return on capital employed. So although I believe this is a good company, I'm not sure whether this would be a good investment, because they have a lot of things not going for them and they have high competition, and I just think they have a lack of direction, especially lacking growth. So having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.